Okay, so good evening, everyone. This is House of Accountants, and my name is James Olashere. So we just want to look at the Finance Acts I just released, and we look at the changes. We interpret some, and we also look at the implication or benefits for implementing such a. But first of all, let me start by introducing the Finance Act. Okay. Finance Act is always passed every year. And the main reason why they pass Finance Act is to do adjustments to some tax acts, maybe company income tax, maybe capital gain tax, maybe personal income tax, and value added tax, and the like. So main reason why they pass Finance Bill or Finance Act every year is to do adjustments to this act, because they can't be changing acts every year, but they can just release or prepare this to adjust to economic situation, current economic situation. So that's why they pass Finance Act every year. And they started this, since they started this, they've done some amendments, over 40 amendments now, to the existing tax and regulatory legislation in Nigeria. So they started this Finance Act. The first one was 2019, which was signed by President in 13 January 2020. Then also, another one was released, that's Finance Act 2020, and was signed by our President in December 31st, 2020 as well. Then the Finance Bill 2021 was signed on 1st of January 2022. So that's just a brief history about our Finance Act. So let's go to what we have today. So the purpose of Finance Act, which we have said, the primary objective of Finance Act is only to prescribe the rates so that the tax can be charged under the income tax or under tax law. The income tax is a permanent act, whereas Finance Act is passed every year. And its main purpose is to fix the rates to be charged under the income tax for the year. So the act is permanent, but Finance Act is used to adjust, to do some adjustments to it so that it will fit into current situation. Okay, so as we go on now, I want you to take note of these keywords because we'll be making use of it. When you see repealed, it means reversed or cancelled. Then when you see tax deductible, it means allowed to be subtracted from the total amount of a person's income before calculating the tax he or she required to pay. For example, now, maybe someone has a personal income of 20,000. If there is a tax deductible of let's say 1,000, so it means before you charge tax on that 20,000, you must remove that 1,000 naira first. So what you are going to charge your tax on is 19,000. So we'll be making use of these two words as we proceed. So let's go to what we have, our main objective. So far I've gone through the Finance Bill for the year 2022, and there are some changes that really affected all these acts. Don't forget, they cannot change the act. They cannot change this act because they are permanent, but they created a finance bill that will adjust what we have here. And once it's signed by the president, then it becomes what we use for that particular year. And it's always be in the advance. So what you want to use in 2023, like Finance Act 2022 now, we will start using it in 2023 financial account. For example, if our accounting year end is 2020, or sorry, if our accounting year end is December. So Finance Act for 2022 now will be applicable for what we are going to use in 2023. Every transaction we are going to make, we are going to do in 2023, Finance Act 2022 will be applicable to it. So that's what I want you to understand from there as we move on. So it affected Customs and Excise Tariff Act, then Petroleum Profit Tax. We have a Value Added Stamp Duty Act, Procurement Act, and the like. So let's go straight to the business now. So the first one is gain on digital assets. So it says gains on digital assets, including cryptocurrency, to be specifically chargeable to tax under Capital Gain Tax Act at the rate of 10%. So what capital gain tax is saying is that if you have an asset and you dispose it off, you look at the current value of that asset, then you look at the proceed and the costs you incur in selling that particular asset. So by the time you net it off, that's what we call gain. If your proceed is higher than the cost plus the current carrying value, then you have capital gain. So that gain, we are going to charge 10% on that particular gain. That would be your tax you are going to pay to government. So not only the capital asset, not only the assets now. For example, maybe someone was sacked in his office or in our office, and they gave compensation of 10 million naira. That 10 million naira, you are going to pay capital gain tax on it, which is 10% as well. So in this place now, there's an adjustment. I believe you all know what we call cryptocurrency. And currently, it has been an asset that many people buy, and when they want to sell, they sell it and they make gain on it. You can buy it maybe like 5,000. When you want to sell, you sell 10,000. Now, what the law is now saying is that once you dispose such assets, you must pay capital gain tax of 10%. I think we are clear with this one. Now let's go to number 2. Number 2 is saying capital losses on chargeable assets, including share, to be tax deductible. Don't forget, we discussed that word, tax deductible. Let's go back here. I said, anytime you see tax deductible, it means allowed to be subtracted from the total of that amount before you calculate your tax on it. Okay, fine. So let's come back here now. So capital losses on chargeable assets to be tax deductible against chargeable gain on the same class of assets. Currently, losses incurred on the disposal of any asset are not deductible from capital gain tax. So currently now, this is what is happening. But now this is a new correction. This is new development for that. And what this means is that, for example, when we say capital loss, you bought, you have a motor vehicle, and the current value of that motor vehicle is 20,000. But when you want to sell, you sold it 15,000. So there's a loss of 5,000. That 5,000 now, you will not pay tax on it because it's a loss. Now you have another vehicle. That vehicle, current value of that vehicle is 20,000. But when you want to sell, you sell for 30,000. There is a gain of 10,000 on that particular disposal of assets. What this loss is saying is that instead of paying tax, which is 10% on capital gain, instead of paying 10% on that 10,000, you have that privilege to remove first loss you have, which is 5,000, from that 10,000. Then what you are going to apply your tax on now is the difference of that 5,000. That is what the law is saying here. Don't forget, there's always carry forward. That is loss relief. So what you are seeing here is loss relief. That is, if they are the same assets, but here now, let's assume the asset is motor vehicle. You have loss on motor vehicle, on disposal of motor vehicle. Then you sell, let's say, plants, maybe machinery, and you have a gain of 10,000 on that. This law does not apply to it because they said on the same class of assets. So motor vehicle and machinery, they are not the same class of assets. But if you have motor vehicle and another motor vehicle, you can relieve the loss and pay tax on the difference. I believe that one is clear. I don't want to flog it too much. Let's go to the next one. Okay, number 3 now. Income derived by a company from gaming, gambling, betting, like BetNaija and so on, or lottery business, to be taxable under company income tax. I think that one is very clear. What this one is saying is that there's going to be tax on gaming company like lottery, I think Green Lottery or something, BetNaija. Any money they make now, there's going to be tax. And the income tax is still going to be on the same rate, 0% for any income that is less than 25 million. Then if your income is between 25 million to 100 million, then you pay your 20%. Then if your profit is higher than 100 million, then you pay your 30% as normal income tax. So I believe that one too is clear. It's not that difficult. Then number 4 now, a company engaged in the commercial winning, capture, production, and utilization of gas will be entitled to a single 50% investment tax credit on its qualifying expenditure for that purpose. What this one is saying is that for a company to buy plant and machinery, especially plant and machinery, there's always 10% capital allowance. After calculating your initial allowance, annual allowance, you are still going to calculate another 10% investment allowance or capital allowance, which is investment allowance. So what this one is saying is that any company that is into this, that is gas, winning, capture, production, their own investment tax will be 50% on that particular asset. An investment allowance is always once in a lifetime of an asset. Okay, I think this one is clear. Now, this one is 10%, but 10% is just for normal companies, which are not into this gas utilization and the like. So this will be number 5 we are going to meet here. So what this one is saying is that investment allowance of 10%, what I just explained now, that is, if you buy plant and machinery, there's going to be, you can see it's a plant and equipment. So if you buy plant and equipment, there's always 10% investment allowance. Now, what this one is saying is that investment allowance of 10% applicable on qualifying expenditure incurred on plant and equipment is to be repaired. What this one is saying is that to be cancelled, to be removed. So it means there's no more capital investment allowance on plant and equipment. That's what this one is saying. And this will, however, not affect such assets acquired on or before 31st December 2022. You know, I told you. So if anything on this Finance Act will not affect anything, any financial accounts in 2022. Everything here will be applicable to financial statements from January 2023 to December 2023. So that's what this one is saying. I believe it's clear. So number 6 now, the rural investment allowance ranging from 15 to 10%, to 100% of cost incurred by a company to facilities such as electricity, water, and tire road, where such facility have not been provided by the government within 20 kilometers of the location, is to be repaired. Now, what this one is saying is that if you have a company and that company is located in a rural area, I mean a very deep village where there's no electricity, there's no water, there's no tar road, previously, what the law says is that for a place where there's no water, you have 50% on your capital expenditure, that is your assets. You have 50%. If there's no water, but there's water, if there's no electricity, but there's water, it means you will be having capital allowance of 30%. If there's no water, there's no electricity, there's no tar road, there is water, sorry, there's electricity, but there's no tar road, you will be entitled to 15% allowance of that particular asset you bought. Now, in a case where there's no water at all, there's no electricity, there's no tar road, what you have to do is 100% allowance. That is, there will not be any tax on that particular asset. So you will add it back. So it will be capital allowance. So if you charge depreciation, you just remove everything at once. So that's what the law is saying here. That's number 6. We have to move fast a bit. So let's go to the next one. Number 7, the partial tax exemption from company income tax granted on income in convertible currency derived from tourists by hotel is to be repealed. What we are saying is that to be reversed, to be cancelled. So 25%, sorry. There's always 25% of the income derived from tourism by hotel in convertible currency is exempted from tax. That was previously. So 25% of any income you derive from tourism, which is by hotel, and is convertible to currency, then it's exempted from tax. But if such income is put in a reserve fund to be utilized within 5 years for expansion or construction of new hotels and other facilities for tourism. So what we're saying is that if you have like a 200 million, or let's say 100 million, based on this from tourism in hotel, you are going to be exempted from tax if you are able to keep at least 25% of that particular income in a reserve. And your intention of keeping it is to use it for expansion of that particular business in future, which is within 5 years. So that's what the law is saying there. But now it has been cancelled. Either you reserve it or you don't reserve it, you are going to pay tax on every income you earn on that tourism. Okay, I believe that one is clear too. So number 8, the CIT, which is company income tax rate for a gas flaring company that is defined as a company that funds or flares associated or not associated natural gas, or less in the case of an emergency, is to be increased from the standard 30% to 50%. What they are saying is that, you know, there's always the tax rate for company into petroleum is always different from companies into normal business like a manufacturing or industry. So what they're saying is that their normal tax rates before was 30%, but now they are changing it from 30% to 50%. So if they make a profit of 100 million, instead of charging 30% to get the tax payable, so you are going to charge 50% on that particular income, on that particular profit. So far, it is a company into gas. Now let's look at this. Gas flaring is the burning of natural gas associated with oil extraction, while non-associated gas reserves are developed primarily to produce natural gas. They may or may not be condensate production together with the gas. Under this condition, it is essential that there be a profitable market to which to deliver the gas. So now associated gas is gas product as a byproduct of a production of a crude oil. So example of this one, and oil and gas, natural gas are used in everyday products such as lipsticks, deodorants, saving medical devices, and the lights. So that's what it's saying. So instead of charging 30%, you charge 50% as tax. Okay, fine. Let's go to next one. If you have questions, we are going to take question after all. I think we have almost 20 changes you want to treat. So we are still number 9. So after treating everything, you can be dropping your question or you ask your question later on. No, number 9 now. An import levy of 0.5% to be imposed on all eligible goods imported into Nigeria from outside Africa to finance Nigeria capital contribution, subscription, and other financial obligations to various multilateral institutions such as the AU and UN. What this one is saying is that there's always a 0.5% import levy on imported goods. So they're going to impose it on any imported goods from outside Nigeria. And what they're going to, from outside Africa, what they're saying is that if Nigeria, let's say from Benin or Cotonou, that's Benin Republic, they want to import car into Nigeria, this 0.5% will not be applicable to it. If Ghana wants to import any good into Nigeria, this 0.5 will not be applicable to it. If Cameroon wants to import anything to Nigeria, this 0.5 will not be applicable to it. But this one is saying that into Nigeria from outside Africa, any country after Africa, bringing goods into Nigeria, there's going to be 0.5%. And this 0.5% they're going to get, all this revenue, they're going to use it on the capital distribution, contribution, subscription, and other financial obligations. Maybe like a loan, repayment, interest, and all this and all the likes. That's what this one is trying to explain to us. Then number 10, all services including but not limited to telecommunication services provided in Nigeria to be liable to exercise duty at rate to be specified via a presidential order. So this one I think is also straightforward. All services, including telecommunication, that is your MTN, your Glo, your Airtel, Etisalat, all these telecommunications provided in Nigeria to be paying exercise duty at the rate to be set. So president will conclude on that. Maybe it's going to be 5%, maybe it's going to be 10%. So based on this now, it means our telecommunication services will also be, the service will be increased. The cost service will be increased, because the more they pay to government, the more the burden will come back to us as the citizens. So that's the implication of that. So their rates also will increase. So they are going to collect from us and pay government. So we are going to be the one to suffer for that. So let's go to number 11. Amendment of the Customs and Excise Tariff Act to clarify the responsibility and powers of Finance Minister to review custom and exercise tariff through the Tariff Review Board. This one is straightforward. I think what they are just saying is they are trying to amend the custom duty, the Custom and Excise Tariff Act, so that Finance Minister will have power to review the law, the act. So they are giving more power to Finance Minister to review. So I think they are trying to bring in control in this one. So number 12, any amount paid as premium by an individual during preceding year of assessment in respect of own life or the life of a spouse or contract for a deferred annuity will be tax deductible. Don't forget, tax deductible will be removed before we apply tax, provided that any portion of a deferred annuity withdrawn within 5 years of paying the premium will be taxed at the point of withdrawal. So let me explain this now. So when you say deferred annuity, it's just a contract. It's a contract with an insurance company that promises to pay the owner. I believe my internet is stable. A deferred annuity is a contract. I'm not sure you can hear me. I think network is bad. Can anyone hear me? Please, if you can hear me, you can just say I. Hello, class. Okay, I stop at number 12. So I was trying to define what we mean by deferred annuity. So I said deferred annuity is a contract with an insurance company that promises to pay the owner a regular income or a lump sum at some future date. So what we're saying is that you can decide as a person, you can start saving every month, or you pay you sign a contract with insurance company that, okay, in 10 years time, I want you to be giving me salary every month of 100,000, or I want you to pay the whole money to me at once in 10 years time. So what you are saying here is that their particular income you are going to get in future is going to be taxed. Why? Because many people now, what they do is that they increase their insurance, their pension, and the likes, so that what they are going to pay less, the tax they are going to pay will be less or lesser than what they're supposed to collect. Currently, when you want to calculate payroll, if you want to calculate payroll based on Finance Act 2021, if your gross income is 20,000, you are going to remove pension first. So if you remove your pension, the balance, that's what you're going to apply your tax on. So many people are using that opportunity to avoid tax. So any amount paid as premium by an individual during preceding year. So what they're going to do now, the tax deductible now will be, you remove that premium. Premium is what you pay every installment. Maybe it's monthly, maybe it's a weekly, or depending quarterly on how you agree with the contract. So you remove the premium you pay, then the remaining one, you pay your tax on it. It's as simple as that. Okay, very quickly, let's move to the next one. Number 13 now, various amendments to the PPTA, that is Petroleum Profit Act, to align with the Petroleum Industry Act, including penalties for making incorrect or late return, recognition of the Nigeria Upstream Petroleum Regulatory Commission tax deductible of a contribution to approve the commission and the abandonment of funds. Now, what they are saying is that late submission of PPT returns attracts an initial penalty of 10,000. That is currently now. Then 2,000 for each day such failure continues, while late payment of tax attracts a penalty of 5% of the tax not paid. That's what the law was saying. But now they said various amendments to the PPTA to align with the Petroleum Industry Act, including penalties for making incorrect or late returns, recognition of Nigeria Upstream Petroleum Regulatory Commission tax deductible of contribution to approve the commissioning and abandoning fund. So I believe that one is clear too. Then number 14, proposed amendment to the sharing formula for revenue from electronic money transfer from the current 15%. Now, what they do currently is that revenue collected from electronic money transfer, that is EMT, there's always sharing between federal government, state government, which is at the rate of 15% to federal government and 85% for states. That's how it's been done before. But now they included local government. So federal government will still be getting 50% as previous. Then states will be getting 50% now. and then 35% will go to local government. So any revenue generated from electronic money transfer, that is levy. There's always levy on that. So that levy will be shared between federal government, state government, and then the local government at 15, 50, and 35%. So one of the most common electronic fund transfer examples are wire transfers, or if you have used a debit card to buy anything online or in store, that's also an example of an electronic fund transfer. So the revenue derived from the EMT levy, don't forget it's levy, is shared based on derivation and distribution at 50% to the federal, and then 50% to the state government, and the remaining percentage, which is 35%, to 774 local governments in Nigeria. Okay, number 15. Okay, I think this number, okay, this is number 15 now. Now, introduction of general anti-avoidance transfer pricing rules to contract any artificial arrangement in respect of transaction between connected persons for FAT purposes. So I'm going to explain that. When we say transfer pricing is always occur between intercompany or related party or related company. For example, House of Accountants has two companies. One is into, let's say, institution. They provide a tutorial and the like, while the other one is into, let's say, computer software and hardware. Now, House of Accountants need some laptop and software to use for these services they want to carry out. Now, because they are related, that is, it is owned by one person, by one director, by one person, what they are going to sell, if that software will cost like 1 million, the part of the House of Accountants that's into software might reduce the price and sell it 500,000 to House of Accountants into tutorial. Or they may increase the price. Instead of 1 million, they may say it's 1.5 and sell it to House of Accountants that is into tutorial. Now, this is implication. If the House of Accountants in a software want to reduce the profit so that the tax is going to pay will not be high, you will sell it 500,000 to House of Accountants into tutorial. But if they want to inflate their profit so that people will see that they are making profit, attract the investors so that they can come and deceive them, what they are going to do when they want to sell to the other arms, their subsidiary, what they're going to do is that they are going to increase the price to 1.5 so that they are going to make higher profit than the normal profit they're supposed to make. That's the implication. And the tax authority now, they are trying to stop that loophole by saying that there's going to be anti-avoidance transfer pricing. The transfer pricing must be at arm's length. That is, that particular software you want to sell to the other subsidiary must be the same price you are going to sell to outsiders who are going to buy, if you don't even know them or they are not related to you. Now, let's go. Simply put, the time transfer pricing usually referred to as TP, refer to how related party price goods, services, intangible assets, loans, and other transactions between them. Now, TIP rules, regulations are established in various countries to ensure that related party prices are reasonable and fair. TP regulations were released in October 2012. That was when they started the Act, they established the Act, and applicable to basis accounting periods commencing thereafter. Commencing thereafter. Okay. Connected taxable persons generally include individuals and entities who share common control, management, and shareholders. If we want to know if this company is related or they are connected, it means individual, the person owns this one, owns company A, also owns company B, or he has control or interest in company A and B. It might be entity, maybe House of Accountants as an entity acquire another entity. So the transaction between them must be at arm's length. So transfer pricing exists. Or if they both have shared common control or management or shareholders. I think I'm good with that. So number 16. Person appointed to deduct VAT at source on invoices received from their vendors and now to remit such VAT to the Federal Revenue Service on or before the 14th day of the following month. No, currently is 21st day of the following month, but now 14th day of the following month. Now let's know the difference. We have two things here that we need to know. Government agencies and oil and gas companies are required to deduct at source VAT charged by supplier and remit it to the tax authority. That's one part. That's part one, because there are two people that deduct VAT. This is part one. Another part is all other organizations are required to collect VAT charged on their invoices from their customer for filing and payment to the tax authority. Now, between the first and the second one, which one do you think this one is talking about? Now let's read it again. Persons appointed to deduct VAT at source on invoices. This one is deduct at source on, the VAT at source VAT charged by suppliers, while the other one is required to collect VAT charged on their invoices. So you should know that it's talking about the second one. So instead of 14 days now, we VAT our VAT, I will refile our VAT on, instead of 21 days, so our VAT will be filed on 14 days. Okay, I think that one is clear. I believe there's going to be question when we are through, so let's continue for now. Then Nigeria companies that are carrying on vatable transaction with non-resident companies within country, government, ministries, statutory bodies, and other agencies of government and companies operating in the oil and gas sector. So I think you are clear with this one. Okay, let's move quickly to the next one, number 17. An importer of goods purchased online. Don't forget, you are importer, but you purchase goods online from a non-resident supplier. That is, you bought those goods from companies that are not incorporated in Nigeria, or they are not operating in Nigeria. Maybe the company is in outside Nigeria. Okay, from non-resident supplier who has been appointed by the Federal Inland Revenue to charge and collect VAT is required to provide proof of such appointment and VAT charge on the invoices as a condition for clearing the goods without further VAT. So what this one is saying is that House of Accountants always buy goods online from foreign country, and House of Accountants has the obligation to charge VAT on that particular and collect the VAT on behalf of federal government, so that when they get to where they are going to clear their goods, they will present the documents and then get their goods. So what it's saying is that if you are unable to present it, condition for that clearing now is that you must be able to present the money you collected on behalf of the government, and not only presenting it, you must make sure you show proof of such appointment if you are giving that such a charge to collect it, and then you give them back their money, because it's not your money, it's for government. So that's what that number 17 is saying. Then number 18, the definition of building for VAT purposes to exclude any fixtures or structures that can be easily removed from land, such as radio and television masts, transmission lines, cell towers, mobile homes, etc. This implies that such assets are not eligible for the VAT exemption on building. Now, let's look at it this way. If I want to build house, there are some items that are exempted from tax, that is that are exempted from VAT. Maybe food items, educational materials, and the likes. Then building materials too are exempted from VAT. Maybe you buy block, you buy cement, and the likes. Now, there are some items that are part of building that have been accepted from VAT from previous. Now they are no more exempted. Example, they said mask. Maybe you have a Airtel mask in your environment or in your compound. You know, when you want to value that building, you value that mask along with the building. For example, maybe you have a tower within your facility. If you want to value that building, you value that towers along with the building. If towers is 1 million and the building is 10 million, if you want to value the whole thing, it will be 11 million. You put it in your account, in your financial statement. So now they are going to remove the one that have been mentioned here: radio and television mask, transmission lines, cell towers, and mobile homes. They remove the value and then apply VAT on it. That's what the law is saying here. So VAT is chargeable on supply of all forms of tangible property, movable or immovable, except the supply of land and building, that is commercial or private, money or security, which are exempted from VAT. So I believe that one is clear as well. Then last one, I guess, 19 and 20. Public officer is required to seek administrative approval and ensure there is an approved procurement plan in addition to existing requirements for the award or signing of contracts. Failure to comply is liable to 3 years imprisonment and a fine of 100,000 on conviction. So what they're trying to say here is bringing control into public expenditure, the way the public officer, how they operate, what they buy. So they must follow the Procurement Act, which was 2007, section 15. So any procurement officer that failed to follow this act will be liable to 3 years imprisonment and 100,000 on conviction. So the manual is intended to give advice and assistance to procurement staff to help them carry out their procurement responsibility, and explains in more detail how specific aspects of procurement should be handled in line with the policies referred to above. It is a source of how to information about the task and elements that comprise the procurement process. So there should not be any foul play, or else they face all these fines and penalties. Then the last one, not the least, the bill indicates a commencement date of 1st of January. I think that would be a mistake anyway, instead of 1st of January 2023. So they mentioned 2022. And then also I'm seeing educational tax at 3%. You know, they keep increasing education tax from 2% to 2.5. Now they are still proposing to be 3%. So what they are saying is that your education tax will be 3% on accessible profit. You know, education tax is charged on accessible profit. If your accessible profit is 30,000, then you charge 30%. I mean, you charge 3% on it for educational tax. Then the balance, you calculate your tax and then the lights, capital allowance, and then you pay your profit or loss on that. So what I say, even either you make loss or profit, as long as you have accessible profit, you must pay educational tax. Either you make loss or profit, you pay educational tax. Okay, then they are also proposing to change their federal inner revenue to another name. Well, that's another one too. Okay, so we'll be taking question now, but before question, let me just say, let me share, maybe it's necessary, or I will drop it on the, okay, I will drop it on the platform. You have access to it on the platform for you to go through. So if there's any question, we can start taking questions. So I have a question here. Let me see. This is the Procurement Act 2007 applicable to private sector. No. The Procurement Act is only applicable to public sector, for those who want to public sector. So they are the ones that buy and spend our money. So they are trying to bring control. So you can't just decide and buy whatever you want and then this, no. So that's what they are trying to do, trying to put control into how they procure items. Okay, so within 2-3 minutes, I want to take questions. So if there's any question, the floor is open. You can drop it on the chat box, or you can unmute yourself and ask your question.
Hello.
Okay.
Good evening, sir.
Good evening, sir.
Thank you for the lecture.
You're welcome, sir.
Mike, I have 3 questions to ask. One, okay. December VAT filing, we will file it in January. Does it mean that we file it before January 14th or that's 21st? That's question number one. I hope you got it, sir.
Okay, so you want me to answer the first one, or you want to ask?
No, I will just go through. Question number two.
Okay.
Recently in my office, we have a contract with MTN, and MTN gave us a notice that FRS has already appointed them to deduct VAT from our invoices.
Exactly.
Now, but did it say it in the Finance Act, appointing FRL, MTN and banks to be deducting VAT from customer invoices and such? Then question number three, with respect to goods being imported into the country, I think VAT and withholding tax are part of custom duty collected by the custom at the point of entry. So with respect to, I know that the acts specify that people are appointed and should have that evidence of being authorized to deduct VAT from their transactions, online transactions. So I just wanted to clarify this. Yes. Please, can you clarify these three questions? Thank you.
Okay. All right. Let me take the first one. Let me start from the last one. The last one, sales, I think is number, let me try to take that again. That is talking about, okay, this is it, number 17. An importer of goods purchased online. That's what the law is saying. If you purchase, you always purchase your good online. You order it online. Then they bring it from abroad into Nigeria. At the entry point of those goods, when you want to go and clear your goods, you must present the appointment and the VAT you charge on it. If you're unable to present it to, then you'll not be able to clear your goods. So they are trying to mandate it now, compulsory to everybody, that if you are purchasing online, you must charge VAT, or else you'll not be able to clear your goods. So that's what they're saying. So as long as you have been appointed to do that. Then number two, now your question two, for the mask, just as what we have said in, let me go back to that one as well. Okay, this is it here. So building for VAT purposes, to exclude any fixtures or structures. If you look at that mask, MTN mask or mobile mask or whatever, they are part of this furniture. They are part of this, the definition of building. They are not actually part of building, but if you want to value your building, it will be part of the value. You have to add to it if you want to present it to your financial statement. So what the law is now saying is that it's going to be VATable. They are going to apply VAT on it. Maybe the revenue you are getting from there, maybe you gave it to them for 12 months, there's going to be VAT on it. So VAT is now chargeable on the supply of all forms of tangible property or movable or immovable, except the supply of land and building. So that's what the law is saying there. Then for the VAT filing, what it's saying is that if the transaction, if you collect the invoice, maybe you give invoice on 1st of January 2022 or 2023, don't forget that everything in this Finance Act you are seeing here does not apply to 2022. It will apply to every transaction you are going to have in 2023. So whatever VAT you collected on behalf of government from January, let's assume January 2023, you must file it on or before 14th of that particular month. think that one is clear. So instead of 21, you file it on 14. Okay, I believe that one is clear. So if it's not clear, you can still signify. I will answer, I will repeat that. Okay, so I have so many questions here. The first one says, is rent portable? I think from 2022, there's if you want to rent, if you want to give out your rent or use it for, you charge VAT on it. Maybe anybody want to use your facility, so there's always VAT on it. From 2021 Finance Act, so it has been like that, and there's no comment on that in Finance Act 2022. So it means the process will continue. Then thank you for your immensely for this insightful presentation. Please kindly help to copy the copy of the presentation. Sure, I will send the presentation to the group for everybody to check it over and over again. Thanks, Prof, for the insight. Kindly share the slide on our platform. Yes, I will send it to the platform. Thank you. Hi, Prof. My first question is, how does the government monitor the company, the capital gain tax at over 10% on proceeds made on cryptocurrencies? Well, they're about to start that now, and I believe CBN will also be involved in that. What they are, the main reason why they are bringing in this capital gain tax, at onset, CBN is not really in support of cryptocurrencies. So they want to use this one to discourage those who are into cryptocurrency. If you know that, okay, I buy 10,000, I sold it 15,000, and my gain is 5,000. Instead of me to keep this particular 5,000 as my own gain, I'm still going to pay 10% on it to government as a tax. So many people will start thinking about it before going there. So there's a way they are going to track it. They have your BVN, they have your information. I believe they have process in place to track every proceed of cryptocurrencies. Then secondly, please explain the point 12. Okay, point 12. Let's go to point 12. Let's see what point 12 is saying. Any amount paid as premium by an individual during preceding year of assessment. Tax is always in preceding year. Then premium, this premium is also in preceding year. That is what your premium last year or your premium in December will be paid in January. If that is your own method, that is okay. I'm not paying in advance. I'm not paying in actual months. If my premium is, my monthly premium is 10,000, and I have paid up to December. So my own payment, my payment for December, 10,000 for December, I will pay it in January. Now, for the period of 12 months now, you have collected your income or your monthly income, if you agree to be collecting it every month, or you agree to collect as a lump sum. What it's saying is that if they give you a lump sum of 500,000, tax will remove what's supposed to pay in January. They will remove it from that lump sum. And then the remaining one, they tax it. I don't know, maybe that one is clear now. The remaining one, that is tax deductible. That's what it's saying here, that a contract for a deferred annuity. So what you're supposed to pay in December and you pay in January, that particular amount will be tax deductible, provided that any portion of the deferred annuity withdrawn within 5 years of paying the premium will be taxed at the point of withdrawal. So if you are withdrawing 50,000 as your premium, as your contract, on your contract, and you have the deferred premium you're supposed to pay, let's say 10,000. So it will be 50,000 you collected minus the deferred premium, which is 40,000. Apply the tax on that particular premium. So that's what you're going to pay as tax. So I believe that one is clear. Let's look for the next one. Okay. Let me see where I stopped. I've answered this. Lastly, when will this be turned law? Is it before 31st of January or? So this law this act you are seeing will be, it will apply to any transaction from January 1st, 2023. So the B doesn't affect any transaction in 2022, but immediately we shout Happy New Year. Any transaction from that period, this Finance Act will affect it. Okay, Prof. Sir, does the new Finance Act with the effective date from January has anything to do with the next ICANN exam? Will students have to follow this new act to write exam like taxation and likes? No, ICANN will not test question, will not test development that is not up to 6 months. So any development that is not up to 6 months, ICANN will not test it. So is in the bronchial. If you want to check, you will see that we explain it there. ICANN will not test any new development or anything that is not up to 6 months. And this one will not be up to 6 months before you write your exam. Exam is in May, right? And this one will be effective from January. So January to May is not up to 6 months. So definitely you won't see anything under that. Okay, please come again. You said if you are purchasing online, one must charge VAT. How, please? I believe I can only charge VAT if I'm selling online, while equally pay if online. Okay. Prof, thank you for the wonderful presentation. Please, can you share all the presentation slides after this time out? I will share that. Concerning the cryptocurrency, it will be hard for government because